Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we are talking about some of the hottest stocks on the market right now. These companies have seen massive growth, massive valuations on them, and we're talking about Canopy Growth, Tilray, and Kronos. We're talking about the MJ stocks that are in the MJ space. And when you look at these companies, you see massive opportunity. You see a massive market, a lot of profitability in the future, and massive revenue growth. But when you see that up front, it's very easy to get attracted to these stocks because they're rising up quickly, they're having lots of attention around them, and when you see these stocks, it's natural to immediately want to jump in them and invest in them and then watch where it goes. But that said, I think it is a mistake, and in this video, we're going to go over those reasons why I think there are issues. We're going to go over the major hidden issue for shareholder in these stocks. I think a lot of people aren't paying attention to this. I'll point out some of the major issues that a lot of people see, but there's something that I think a lot of people are not even taking into account besides the high valuations, the unprofitability, and things alike. But when you look at these companies, I mostly want to focus on the main three. The three that I watch the most, the ones that probably most people watch out there. And the reason why this is important to me is that Kronos has a partnership with one of the companies that I own. I've performed very well over the last year or two since starting this channel. We have now broke $10,000. And one of my holdings, which I've even considered increasing, is Altria. And Altria owns a stake in ticker symbol CRON, Kronos. So Kronos stock is very important to me. It has to deal with the success of one of my companies. So it's important to me that these companies exceed. But when you look at these companies like Kronos, Tilray, Canopy Growth Corporation, there's a lot to worry about and new investors that are investing in them. I'm going to give you my reasons why you should not invest in them. So before we jump into all that, my name is Jordan. I'm the Millennial Investor. If you've not followed me before in the past, my name is Jordan and I run my channel based off a dividend growth investing strategy. These are the 24 companies that I own and what they pay me on an annual basis in column A right here that I'm highlighting. And if we scroll over here to the right, my annual and monthly dividend income is charted every single month through these two charts right here. And then if we scroll down, I have two other charts as well, including my portfolio value and my monthly YouTube income. I disclose every single thing on my channel, including buys, sells, dividends, referrals, everything you could possibly imagine. And these are my goals for 2021 and my 2021 stock market prediction for the S&P 500. But one of the reasons why we've had a lot of success is that we've got a lot of people sign up with M1 Finance. So if you watch this video, you find some value in it, and you decide that you do want to invest in these companies if you go against what I'm saying, or if you decide that you want to invest into a strategy that's more like mine, a more dividend growth investing strategy, or if you just want a new brokerage, all the things are alike. If you want to get signed up with M1 Finance, right now they're having a massive promotion of having $30. All you got to do, sign up, deposit $100, use this link right here. It's down below in the description. We've had 88 people sign up so far, and all 88 have said that they absolutely love it. So go ahead and get that number to 100. I'd really appreciate it. But if you download it and deposit $100, you'll get $30 just for getting signed up. Free 30 bucks, that's all you got to do. But anyways, guys, let's go ahead and jump into these three companies and why I think that a lot of people are not paying attention to the things that are important. And the one that I really want to focus on in this video the most is Canopy Growth Corporation, because Canopy Growth is the largest of all of them. They're the big dogs, okay? They acquired Acreage Holdings as well as a lot of other smaller names, and they have big names. They have big name partnerships like Constellation Brands. This is part of the reason why this company has had success. It has a massive stake in Canopy Growth Corporation, and that's why this company has been uptrending back again here in 2021. It has had that massive stake in Canopy Growth finally started to pay off. But when we look at CGC, let's go ahead and look under the hood because the share price tells you virtually nothing. And let's go ahead and talk about where these three stocks are being valued at. They currently have a price to sales ratio on Canopy Growth at 30 times. So it is being priced at 30 times its sales, and that's even after today's drop, which remember, it dropped over 22% today. I'm filming this on Thursday, February 11th. It dropped over 20% today, and it's still being priced at 30 times its revenue. So that means that right now it's going to be expected to do about $500 million roughly in 2021. That's what it's expected to do. And right now it's trading at 30 times that amount. If we look at Tilray, and this is once again extremely high, much higher than Canopy Growth, it is being traded at 34 times, higher than Canopy Growth. And then Kronos, above them all, it's so high that it's not even funny. It's just flat out a joke. 116 times its price to sales ratio. And for me, which is most important, this is the one that I need to succeed. Out of everything, this is the one company I need to succeed, and it is by far, far and away the most overvalued. But when we look at these companies and we see that they have done very well over the past year, I want to show you the 5-year charts on these companies. You notice how other than Canopy Growth, most of these have done pretty bad. So let's go ahead and look at Tilray. When it initially went public, it skyrocketed. A lot of hype, a lot of opportunity, and it went all the way up to at one point over $300 a share. And this company initially went public around 20 bucks. Now, if we go back to early 2020, it was $2 a share, a 90% downturn from its IPO price, and like a 98% downturn from its all-time high. And just recently, it's just now started to uptrend. Because we look at the 2-year chart, it is just down and down and down. And that is because all these companies do not experience any profitability whatsoever, and the revenue growth opportunities for these companies is a lot more limited than these type of people expect. Like Cronos, for example, the one that I need to be successful, in early 2019 was $23. But if we go to mid-2020, it was $5 and $4 a share. Massive downturn. And the reason for this is one of the main hidden issues for shareholders in these stocks, and it is share dilution. And no one does it better other than Canopy Growth. This company has been issuing shares at rapid levels. All these companies has, it's not just Canopy Growth, but I went ahead and pulled up some of the numbers for ticker symbol CGC. In 2015, this company had 98 million shares outstanding, which basically means if you were to split up every single share of the company to where you had to own every one of them, you would have to buy 98 million pieces of this company to own it outright. That's what split up between all the different shareholders out there. You, me, the big guys, the hedge funds, to the small retail investors that just own 2 and 3 shares. That's everybody. Now, if you get to 2021, there's now 372 million shares. There was 98, now there's 372. Now, why is that important? What these companies do, they're trying to fund their operational growth. They're trying to fund their operations to grow new flowers, new products, new branding, new facilities, and all types of things alike to fund further revenue growth. Now, that's great. That's great that they want to reinvest back into their business to expand operations to have more revenues. But the issues with this is that one of the ways that these companies mainly raise funds is by diluting shares to shareholders. So what they'll do is they'll offer more shares. So let's say this company started out with 98 million, and I'm just throwing out a number, just random. Let's say they offer 10 million shares at just below the share price. Let's say it's trading at $40 right now. Let's say they offer it at 35. Well, that immediately does two things. That will take the share price down to $35 a share, where they priced it at, and that means that your shares are now worth less because there's more shares out in the market. So think about it this way. If you own 1 share and a company has 100, then you own 1% of the company. 1 divided by 100, correct? Now, if you own 1 share and a company increases that to 200, you now own 0.5%. So your ownership is a smaller stake in the company. Now, that's the same thing, except this is on a grand scale. Your shareholder value has been diluted 74% since 2015. This company has been issuing shares at massive levels, and this is part of the reason why the long-term charts for most of these weed stocks are not looking good at all. And that's why all throughout 2019, 2020, and even starting 2021, this has not looked good for these companies until the last month or so. Now, if we look at some of these companies, let's look at Canopy Growth, for example. Let's look at the different products and categories that they're in, and while they may be in a high growth category, I don't think it's going to be enough. But we'll go ahead and look at the products that they have to offer and give my opinion on them about that. So first off, they have their edibles. They have a high-quality edible cannabis product. Their facility in Smith Falls is producing cannabis-infused chocolates, and this just talks about the chocolates, but they have lots of other things as well, including gummies and other products like that. They also have things like beverages. They're working with, once again, Constellation Brands, which this is the one major thing that I think is a benefit for Canopy Growth. They have that partnership with Constellation Brands, which is the one saving grace for this company that I really like. But they have their beverage opportunity for both THC drinks and CBD drinks. I think that THC getting passing in drinks is a lot harder than a lot of people realize, but I think the CBD definitely has some opportunity in the coming years. And then they have their vapes. This is something that Altria and Cronos is hitting really hard, and that's the THC and CBD vapes. So that's something that I'm really bullish on for Altria, and I really like the space that they're in, and Canopy Growth is in that as well. They have their just plain dried flower, just their plain flower that they sell in stores, And then they also have things like oils and concentrates. So if you use the oils both for medical purposes or for just a basic consumer purpose, they have those as well. They have soft gel capsules that they sell to the public. And then last but not least, they have things that go in all different types of products like lotions and creams and oils and shampoos. They have hemp products as well. And then the main thing that I think is good here, if there's one thing that I'd be bullish for a company like Canopy Growth outside of their partnership, and this goes for really any of the weed stocks out there, it is their branding. Because at the end of the day, you do not want these products to get commoditized. So what I mean by that is a commodity is something that basically has no branding power. A commodity is something it's everywhere the same that you buy it. If I get gas from 7-Eleven, it's going to be gas the exact same as if I get gas from Chevron. It's going to be the exact same if I get gas from ExxonMobil or wherever the gas station I choose to stop at is. And the same thing goes for other things as well. Commodities are usually things that do not have any type of branding power or any type of product recognition behind them. Now this is an area where these MJ stocks could have the opportunity to create some branding power, because it's just like the thing when I look at my portfolio and I look at the companies that I own. Coca-Cola has some great products. They have some great branding power, and the reason why this company is successful is not due to the taste of their products. Not that they have bad products, but there's a million different companies you could buy beverages from. The reason people buy Coca-Cola products is because familiarity. People recognize the brand. They're familiar with the company, and it makes them feel good. And not to mention they have the verbiage of, oh, grab me a Coke, even if they're not talking about a Coca-Cola. The same thing could happen for the opportunity for these marijuana companies. When you look at these opportunities, the catchy name like something like Tweed is something that could catch on long term. So they have brands like Tweed, Spectrum Therapeutics, Martha Stewart, which is another recent partnership that Canopy Growth just landed. They have Houseplant, BioSteel Sports Nutrition, Tokyo Smoke. They have Deep Space. They have TWD. They have, by the way, I might be saying this wrong. I don't know how to pronounce this, but I believe it's Quatre, if I'm saying that correctly. They have Simple Stash. They have LBS. They have DNA Genetics. They have Doja. They have Vanderpump. They have Craft Bro. And they have so many brands that you can tell that one of these will probably stick. More than likely their most popular Tweed brand. That's why they put it as a front runner. That's why they showcase this brand. But regardless of what happens, I think that these companies can get some benefits from branding power, and I think Canopy Growth is probably doing that better than any other. Now, if we get off of this and we get off the about the company, we get off the products and the branding, I want to talk about an article that was just released here. Canopy Growth shares soar after company CEO says cannabis company will be profitable by 2022. And I think a lot of this is going off of hype right now. People are speculating that the blue wave in the market is going to take these companies to legalization pretty much in 2021, 2022. Now, regardless, I'm not going to speculate on that. There's no way that I can predict what these governments are going to come up with. But regardless, whether it gets passed or not, I think profitability for these companies is probably going to be a lot further out than 2022. And even if I'm wrong, even if these companies experience profitability, I think that it will probably be very slim. And if the first one that's going to reach profitability, it's definitely going to be CGC. It's going to be Canopy Growth before any of these others. And even Canopy Growth, I don't think it's likely that we'll see profitability in 2022 for these companies because they're focusing on revenue growth and they're not focused on profitability. And one of the things that I want to talk about here in terms of profitability and revenue growth, I think once again, it's being overhyped, it's being overvalued. I think that while there is a good opportunity, I think people are not realizing how competitive and how oversaturated this market really is. I just wrote down just some of the ones I can name off the top of my head without even looking them up. This is just public companies. This doesn't even count private companies. They have Hexo, there's Tilray, Aurora Cannabis, Aphria, Sundial Growers, Kronos. There are so many names, and these are just the public companies. These are just the big dogs. This doesn't count ones that have been bought out by all these other companies, all the mergers and acquisitions that have happened in the last decades from all these names, as well as lots of other public companies, and more importantly, private companies. In my area alone, in my city that I live in, there are these type of companies everywhere, and I mean on every corner. They are everywhere, and they're not stopping. They're popping up left and right, and there are going to be so many competitors in this market that it is going to become oversaturated, which it honestly, it really already is. So when you have an oversaturated market, you're really going to get in a bidding war with all these other names. And this is why I say the one saving grace that could happen for this company is branding power. If people look at a brand like Tweed and they say, okay, I'm not buying anything else, I'm buying Tweed. I'm familiar with it, I know its product, I trust it, I like the brand. I'm buying Tweed every single time, day in, day out, and I'll even pay more for that brand. That's branding power that a company like Canopy Growth needs. But if you're comparing this to all these other companies, if they have the same product for the same prices, why would you pick one over the other? They're all competing for the same piece of the pie, and I think a lot of these companies are going to get hurt for it on both a revenue share and on a profitability opportunity. So both public and private, these companies are really going to hurt. So if the CEO is right by 2022 that the company is profitable, I think that that's probably wrong. But if he is right, if they're profitable at 2022, I think it will be very marginal, very small, and not something that shareholders should really rely on. And when we look at how unprofitable some of these companies actually are, including, I hate to say it, but the one that I care about the most, we're talking about Cronos, a lot of these companies are extremely unprofitable. But hopefully that Cronos investment hopefully turns out over the next 10 years for Altria. It would really help me as a shareholder. But regardless, I think these are really have a long way to go before profitability starts to take place. The last thing I want to show here is the balance sheets and the cash flows and the income statements for these companies. Because obviously revenue growth is what we're looking at here. People that are investing in these companies have to worry about revenue growth and pretty much nothing else. Now there's a couple bright spots that I will recognize here. It's not incredible, but it's not that bad either. And I'm honestly pretty impressed with the balance sheet for a company like CGC. First, let's look at the total revenue. These are annual numbers, so they have not come out with the 2021 numbers because this is February. These will come out in the next month or two. But going back to 2017, these numbers are in thousands. So they did $30 million in revenue. The next year in 2018, they doubled it to $60 million in revenue. So about 100% revenue growth. Very good. $60 million in revenue to $190 million. So over a triple up in revenue. Extremely good. Then they went from 190 up to 308 million. So still very, very high growth. Now, when we look at this, this is where things start to get a little bit tricky. Their operating income. Not good whatsoever. Their operating income and their net income is not good at all. Now, while their revenue might be growing massively, that net income is growing right alongside it. Their negative net income, I should say. And what is it, 2017? Yeah. So at the end of 2017, they did negative $5 million in net income. The next year, they did negative $50 million, 10 times. The next year, they did negative $550 million applicable to shareholders, and now they're looking at getting at $1 billion loss in net income in 2020, and going into 2021, that number is expected to grow. So when you're looking at a company that is producing losses, not gains, but negative numbers of net income of the billions of dollars, that's obviously not good for shareholders. Now, also, before we get to the balance sheet, I'll show you the cash flows here. But once again, negative cash flow numbers in 2020, and a lot of these cash flow numbers is mostly because of issuances of debt. This company is not in a financial place that is going to probably look good over the next 5 years. It's not horrible now, but it's probably going to get worse. And let's go ahead and look at the balance sheet for now. Right now they have $900 million in cash and about $500 million in short-term investments. So what is that together? That's like right at about $1.4 billion if you add these two numbers together. So $1.4 billion in cash, but their long-term debt is only $500 million. So the good news is they have a lot of opportunities to raise right now, and I think that this company should honestly be focusing on long-term debt rather than share issuances. Because like I said, the same way that this company diluted shareholder value 74% just in the last half decade, I think that the opportunity for a company like Canopy Growth could probably offer some debt issuances while right now interest rates are at incredibly low rates. So Canopy Growth has opportunity to raise debt at incredibly low rates, and this is an opportunity as a shareholder. But that pretty much wraps it up, guys. I showed you a lot of the main bullet points for these companies. Overall, don't trade on hype. Trade on fundamentals. Don't trade at all. Invest. Don't trade, invest. Tread lightly. Do your own research. None of this is financial advice. This is just my fun opinion, and I think that a lot of these companies are ones that I'll likely never own. Basically, I technically own a small part of Cronos because I invest in Altria, but other than that, these companies are not anything that I'm investing in. I'm a boring dividend investor, and if you want to follow along with me, I'd invite you to subscribe. And like I said, if you want to get signed up and earn that $30, you can go ahead and do so down below. But thank you guys so much for watching, and I'll catch you guys next time.